Hi there, Craig here from Building Loans Australia. Welcome to this 2025-2026 version of the complete Australian construction loan guide. Over the next 25 minutes or so, I'm going to walk you through everything you need to know from different types of build options you have, all the way through getting finance approved, settling, and beyond, even post-settlement. So welcome, and today I'm going to walk you through in some detail the different types of build that you can do, different sort of building structures. How does it actually work? So stages, interest rates, and so on. What do you need? Documents to actually get approved and to get your house built and moved into. What help is available? First time owners grants and things like that. What can and does go wrong? Common mistakes. A real example, our solution, and finally, how to get started. Very briefly before I go on, a little bit about Building Loans Australia. I founded Building Loans Australia in 2011. I just built my first house and realised this is way harder than it needed to be. So I thought I'd jump in and actually help solve that problem. So over the last sort of 15 years or so, there isn't really anything we haven't seen from a building or construction perspective for a residential property. And also we have our amazing Progress Protect method as well, which just is not only our expertise and knowledge in getting you approved, but also making sure that your timeline's protected, your budget, and you have peace of mind throughout the build and not living on baked beans and things like that. So that's a bit about us. And before I get started, it's important to note that probably goes without saying, this is not financial, legal, or taxation advice. It's for general information or educational purposes only. Okay, so on to our first topic, which build type are you planning? So firstly, I might just cover very briefly what are the sort of 8 most common build types out there. And the first most common build type is a house and land package. So a house and land package is, typical example of this is you've gone to a big release of land to an estate, for example, and you'll find builders have display homes there, and you sort of go, look, I'll have lot 1 here, and I'll have this build contract and plans here. So the builders already have their designs and houses, they have hundreds of them all ready to go, ready to go, and you go, I'll have that block of land with that house, please. And we call that a house and land package because you're literally getting the land contract at the same time as getting the build contract plans and so on. So house and land package are by far the most common. It's also quite streamlined. It's less risk if you do it all together, the house and the land at the same time, which means also can mean faster approval as well. So house and land package is like a bundled deal from the developer. The second most common example is land first then build. So the difference to this one than a house and land package is you sort of go and find the land yourself. It might be in an estate, it might not be, and then you go and find your own builder, right? So often what happens here is you end up settling on the land. The land is purchased in a separate transaction. You've settled the land. You now don't have the keys to the land, but you can go and put a tent on it. You own the land and you start paying a mortgage on the land and you start paying rates and things like that. You own the land and then you go and find a builder to build you a house on that land you already own. So that's land first then build. It's quite common. It does mean more flexibility to you because you can obviously choose the land and the builder you want to go with. Maybe more flexibility to you, a bit more control, but there is a slightly increased risk here. And the risk is that you've purchased the land, you've settled on the land, you're making repayments on the land, and let's say you lose your job, or let's say there's a downturn and property prices fall, you could find yourself owning a block of land that you can no longer afford to build on. Maybe at the time of buying the land you could afford to build on and there was enough value there and you had enough deposit, but by the time you came to build on it separately, valuations have fallen, or you've increased your debt, or you've lost your job, or something like that. So certainly very possible, and I've never seen that happen personally. Thank God. But land first then build is also a very common scenario, just slightly increased risk. So don't take too long between buying the land and getting a builder underway. The third one, which I won't spend too much time on, but it's called an off-the-plan purchase, primarily just so that you understand the concept here. Off-the-plan purchase is used typically for your big, buildings in cities. A developer is building a high-rise, 50 stories in the air, and you want to buy, unit 1 on level 11, for example, for $500,000. We call it off the plan because you'll pay your 10% deposit when you agree to buy it. Typically, maybe the building's not even started, so you're sort of buying it off the plan, it hasn't even built yet, and you're agreeing to pay the other 90%. So you pay 10% then, and you're agreeing to pay the other 90% when the building is actually completed, in 2, 3, 4 years' time, or whenever it happens to be completed. No progress payments, you just pay 10% up front, the rest at settlement. Quite a bit of risk there though, because you're agreeing to buy an asset, at some time in the future that you don't know when that will be. Who knows how long that'll take. And for a locked-in price that is today's price, $500,000. If prices go up, happy days, for your 10% deposit. If prices go up by 100, you've made yourself, a lot of money. And that's been happening quite a lot recently. However, if prices go down and that 500 grand property is only worth 400 grand when it's ready, which happened quite a lot in the early 2010s, you then might struggle to get finance approved for that unless you can put in significant extra money. So off the plan purchase is generally for the high rise, and there is some risk with it based on the aforementioned comments. Finally, the other very common scenario we see is renovation, so renovating a kitchen or a bathroom, adding on a 5th bedroom. And there's also the concept of a knockdown rebuild. So if you really don't like the house, you can knock the whole thing down and do a rebuild. So we also see quite a bit of that as well. Some less common scenario, but ones that we do quite often, is building a dual lock property or a duplex. Effectively here what you're doing is you're building 2 dwellings on one title, or 2 dwellings on one block of land. A dual lock just means that you haven't split them, meaning that you couldn't just sell one or sell both separately, or sell one and live in one. If it's a duplex, you can. So if it's a duplex, it's been titled rather. It'll be 1 John Street and 2 John Street, for example, and you can sell one and keep one, or sell one and live in one, whatever you want to do. That's a duplex. A dual lock is more when it's like a duplex, but you haven't actually strata titled them yet, so you couldn't sell them individually. And another example of a dual lock is like a granny flat. 2 dwellings on one title. You got your home that you're living in, and the granny flat as well. So dual lock and duplex, I've just finished doing one recently, and it's currently rented out and in the process of being sort of strata titled, so that I can, if I want to, I can sell one and keep one, or I can sell both separately. So I'm currently doing that at the moment. Next one is, we see a little bit of this, 4 dwellings on one title, certainly possible at normal interest rates, that's cool. Owner-builder projects, we see quite a bit of this. You're not actually generally building the house yourself, not generally, although in some cases you might be, but more that you're sort of controlling the spend. So there might be some things that you do, but you're getting in the bricklayer to do the brickwork, you're getting in the plumber to do the plumbing. You're more project managing the build, and we max LVR is 60%, and you do have limited lender options, but we are talking mainstream lenders, so but limited lending options, because quite tedious and big deposits, quite tedious, bit risky to the bank, which is why they have that 40% deposit requirements. And finally, we do the kit homes as well. Most banks don't like kit homes, but we can help you there as well, but I won't go too much in detail here for that one. All right, so how do construction loans actually work? Well, so how they generally work, let me get rid of this for a second. How they generally work is you will settle on the land, right? So house and land package, or land first then build, doesn't really matter. You settle on the land first, and you start making payments on the land, whilst you have paid a deposit for the build as well. And you're making payments on that land. Then what happens is the slab goes down. That's the first stage. And what happens here is the slab goes down, and the builder wants to be paid 10 to 15% for that slab, and the bank will fund that. So big picture, what's going on here is that the banks don't want to just hand over the entire amount for the land and the entire amount for the build, because there's nothing built yet. Right? If they did that, they handed over 500 grand for a 250 build and a 250 land purchase, and just said, hey, here's 500 grand, and the builder went bankrupt, the bank would lose their money. So what they do to protect themselves against that is they will fund the build in what we call progress draws. They will fund the build as work is done. Only once the work is done will they fund it. So at land stage, they've funded the land. If the builder goes bankrupt here, no stress. Well, not no stress, but just find a new builder. The bank won't lose out, and nor will you as the client. When the slab goes down and the bank pays for the slab, again, if the builder was to go bankrupt here, broadly speaking, the bank's not going to lose out. That's where insurance comes in, but broadly, the bank's not going to lose out. We go and find a new builder, and the bank's still got the money left over to fund the rest of the build, and so on and so forth. So the frame goes up, bank pays the builder a bit more money, lock up, roof's on, doors are on, etc. Pay some more money, fit out, so the kitchen's going in, the bathroom's going in, the things on the wall, fibro, whatever it is, going on the wall, all that's going in here. Again, once that's done, we pay the builder some more money, and your loan is slowly getting bigger. And then finally, the final handover is stage 5, and it's complete, and you've actually got the keys and moving in. So that's sort of how the construction works compared to a normal loan, where it's just all paid because the house is already there. In this example here, for a construction loan, the main difference is that the bank is funding the builder at separate stages as work is done to protect them and also to protect you. And as they do that, your repayments will rise as well. So to that point, here's an example of the repayments. And here's an example of when it's just the land. You just pay $1,083 on this example. Your repayments are down here. But once sort of the slab is funded and the frame is up, suddenly your repayments have jumped up to $1,625 a month. And then as it goes to lockup and so on, your repayments progressively go up until such time as you actually get the keys and move in, and it stabilizes at your actual repayment. So just the idea here is just keep that in mind. Your payments will start out relatively small because it's just for the land only generally. But they do get bigger and bigger and bigger as the build goes through. And of course, during this, you might be paying rent or another mortgage, so you can have a bit of a cash flow squeeze there. So part of our Progress Protect plan is to help you sort of manage that and build in buffers or help you sort of navigate that as best as you can. How do construction loan rates compare? Look, broadly speaking, the rates are the same. The rates are the same for normal builds, house and land packages, land and builds, etc., etc. The rates are going to be the same as if it was a standard dwelling or a standard home already existing. It may be that some banks are not available to you. Like a good example of that is ING Direct. Good lender, but they don't do construction loans, right? So you couldn't go and get a construction loan from ING. But you can get it from other mainstream banks, right? So if ING happened to be the cheapest that month, then you're not going to get the cheapest rate, because they don't do construction loans. But other mainstream banks will do construction loans at their normal competitive rates as well. So interest rates are very competitive for your regular stuff. If you've got sort of a bit more complexity, like acreage, large acreage, or duplex in some cases, it may attract a premium, but again, it's generally only due to fewer lender options. So if you picture a funnel, for this standard build here, you might have, 30 lenders that will help you. Maybe for something more complex, it's only 10, but there's still mainstream good lenders with competitive rates that you might go to anyway, but maybe it's not as cheap as some of the lenders that won't assist with that scenario. And finally, ones like owner builder or so on, 4-on-1 title, do generally attract a slightly higher rate during the build phase, but again, you can refinance that at the end, or we can sort of get that rate down generally at the end of the build. So just comparing a few differences here between standard loans and construction loans. Obviously a standard loan, the property already exists, whereas the construction loan is to be built. As we talked about, the money released for a normal loan is all at settlement. You got the keys, you move in, here's all the money, whereas construction loans are in stages. Repayments during the build, it's principal and interest, unless it's an investment and you've gone interest only, so it's principal and interest. Whereas generally speaking, with the odd exception, it's for a construction loan, you're just paying the interest. So to keep the repayments as low as possible during that build phase, you're just paying the interest only. And once the build is complete, it would then normally convert to principal and interest, unless you want it for an investment and you want to keep it interest only, for example. But to keep the repayments low during the build phase, it's interest only, and also makes for easier accounting as well. Security for the bank for the standard loan, of course, is existing completed home, whereas construction loan, it's land plus the incomplete build. The interest rates, again, look, what I'm trying to demonstrate here is this is the rate today, one of the best rates I could find today on recording of this video, but which is October 2025. But disregard that. The point I'm trying to make is that the rates are actually the same. You know, we could actually get this rate whether we're doing a standard loan with a standard house or whether we're doing a construction loan. We could actually get the same rate today. So the same sort of one of the best deals out there. Loan terms are the same, and fees are broadly the same as well. The only real additional fee for a construction loan is you've often got to pay like a $150 to $300 admin payment every time the bank does a progress payment. So when they pay for the slab, they're going to charge you $150. When they pay for the frame, $150. Apart from that, generally speaking, you can get the same. The fees and charges, etc., are the same. Not always. You know, if you're going sort of more complex scenario, it might be more fees. But generally speaking, for your typical house and land or land and build scenario, the fees will be the same, apart from the additional fees for managing the progress payments. Okay, moving on. What you'll need to do to get approved. So, look, mainly you're going to need to do a complete build documentation, so fixed price building contract with plans and specs. So what we're talking about there is there'll be a build contract from the builder, which will outline who they are, who you are, the terms of the agreement, finance clauses, and the price, obviously, and also the progress payment schedule. So in the build contract, it'll say, you know, it's 300 grand, and we want, you know, 30 grand deposit, and then 45 grand when the slab goes down, or whatever it might be. So the build contract, and with the build contracts comes the plans, which is the drawings, how it's going to look on the site, where the builder, you know, where the bedroom's going to be, all those sort of things. And then the specifications are what's included. You know, so is it granite bench tops in the kitchen? What sort of light fittings? And with the fixed price contract, you know, it's going to cost you. The plans, what it's going to look like, and the specs, what are we actually doing? What sort of tiles are we having? We can then give that to a valuer, and the valuer, the bank's valuer, will go out to the property and they go, okay, on this property it's going to look like this, great, and this is what's included. And they can then go, okay, this property is going to be worth X, you know, 500 grand, 550, whatever they say it's going to be worth. So we definitely need the build documentation. The builder also needs a license, of course, and contract works insurance. And they'll also need council approvals before build begins. But the builder will generally arrange all that for you from the council approvals. You just need to make sure you get these items here to get the initial loan approved. Documentation-wise, look, it's just the usual things you need for a loan: proof of income, bank statements, proof of the deposits, or deposits you've already paid. And sometimes you'll need like statements on existing debts, and sometimes you'll need living expenses breakdown as well, depending on the lender and so on. And finally, we sort of discussed land and valuation, but if you already own the land, you're going to need a council rates notice, generally speaking, and if you don't, then a contract of sale. And the bank will do the as if complete valuation, meaning when this property is complete, how much will it be worth, and that is what they will lend against. All right, let's have a quick look at grants and government incentives. So there are quite a few at the moment, 2025, 2026. There is the first home guarantee, which is now available to anyone that is a first home buyer or has not owned a property in Australia in the last 10 years. It means you just need a 5% deposit, and means you can avoid paying lender's mortgage insurance. I won't bother going into what that is, but it saves you, you know, a lot of money, 15 to 30 grand easily. Maybe it's a bit less, maybe a bit more, but it can save you a lot of money. So that's a great scheme, and it's now uncapped. So there's no sort of limit on your purchase price. The second grant that's potentially available to you is the first homeowners grant, which can be $0 to $50,000, which I'll show you in the next slide. But it does generally caps out at $750,000. And there are also some stamp duty concessions throughout Australia as well, based on the state. So in some states, stamp duty will be free if you're buying land and building. In other states, you might have to pay stamp duty. For a bit more detail here, you can see that in Queensland, for example, contracts is a 30 grand first homeowners grant, but again, the property value must be under 750. In Northern Territory, it's $50,000 for new homes. And then you'll find here that for Victoria, WA, etc., it's about $10,000 for a first homeowners grant with some caps
that are involved. So they're the grants that are available to you, and definitely your mortgage broker will help you take advantage of those. So please reach out. Okay, so moving on to the top construction loan pitfalls. The first one is underestimating the build timeline. So look, our Progress Protect methodology will help you with this anyway under our buffer and breathe mantra. But look, everyone wants to think their build's only take 6 or 9 months, and I've had this happen recently. Just finished building 2 houses, and I was supposed to be finished in 9 months, and took 2 years. Now, hopefully that won't happen to you, but both of them took 2 years. And everyone likes to think it'll just take 6 or 9 months. It often doesn't. I've built 5 or 6 houses in my lifetime, and most, well, not all of them, but certainly a lot of them overran. So just build. Hopefully it won't take 18 months, but with our buffer and breathe mantra, we generally like to budget for 18 months, and we want to make sure you can still afford it and comfortable with repayments through that 18 months. So build in that 18-month buffer. The second one is choosing the cheapest lender. Now, cheap is fine, except often what we found with one of our builds many years ago was it didn't include enough for the concrete, enough concrete for the driveway, or it didn't include some of the internal stuff, that you don't sort of think about when you're looking at the contract, and then when the house is built, you go, oh, where's the blinds, or where's X, Y, Z, right? So just be careful with that and review the contract carefully. And most recent example was our concrete driveway. They came to us and said, oh, look, you've got enough just for it, but it'd be very narrow and skinny, right? So just keep that in mind when choosing your cheapest builder. Always build in a buffer. Make sure you've got a bit of a buffer for those sort of items that may overrun or extra costs there. Ignoring interest rate creeps, not interest rate creep, but interest creep. So the longer it drags on, your repayments are going to add up. So keep that in mind and budget for that. Contract fine print. We had a contract where there was a no media clause. You weren't allowed to contact media, meaning I almost couldn't provide a testimonial or some feedback on the builder on Google or on Facebook or something like that. Or no liquidated damages clause. So if the builder overruns the contract, and they take 18 months, and they should pay you under some liquidated damages clause, but they'd put down $1 for every day they're over. So just look very closely at the fine print there for liquidated damages in particular. If they are delayed, you want to be sort of compensated and paid for those delays, and not just some nominal $1 a day. And finally, if there are overruns or delays, just communicate early. Like, the bank doesn't really want they don't want to reapprove the loan again if they can help it. So let's just keep in communication with the bank, and we'll help you with that with our builder lend sync process. So they're your top main construction loan pitfalls I see. Mainly it's around builds generally take longer than you want and longer than the builder quotes. Making sure you review the fine print, what's included, and also liquidated damages and so on, and just communicate with your broker. Look, a real example here of Sarah's build. This was a few years ago, as you can see by the price of the land. But the land was 180, the build was 380. So it was a house and land package. So the total house and land package was 560,000, and back then it was 30 grand. So she had a bit of a deposit. So bottom line is the loan amount she got was 465. Her rate back then was 5.36%, and it took 18 months to build that house. So she had interest throughout that build, plus fees, about 42,100. So a little bit of a case study there to look at. And here you can see sort of the idea of this progressive drawdown. So here's when the land's sort of funded, and then as sort of months go by, the loan gets drawn down, and your repayments will go up until such time, of course, as the loan is fully drawn down. All right, now on to some frequently asked questions. What does interest only during construction really mean, and how does it affect my repayments? So interest only during construction simply means that you're just paying the bank's interest. So if you've borrowed or agreed to borrow, $500,000, if it's interest only, you make payments, you're paying the interest to the bank. After month 1, you still owe 500,000. You then make month 2 payment, which is interest only. You still owe the bank $500,000, as you're not paying anything off the principal. So interest only just means you're only paying the interest, and you still owe the bank the same amount of money. You haven't paid down the loan at all. So what it does is it keeps the repayments as low as possible because you're only paying the interest and not paying off any of the actual debt itself. How long can my construction loan drawdown period be before I must convert to a regular loan? Look, ultimately the loan will automatically, when the construction is finished, right, it'll convert to a regular loan. So construction finished, the bank makes the final repayment, you've got the keys, you move in, and it's basically converted to a regular loan at that point. If you had to go to a bank, if you've had to go to a bank that has a higher rate or a different sort of product because you had something a bit niche, then it's that point in time that would then look to arrange a refinance or a restructure to get you into a regular home at a regular rate. So, but broadly for a house and land package or a land and build, your loan just automatically converts to principal and interest once you get the keys and move in. Can I combine land purchase and build into one construction loan, or do I need separate loans? Yes, you can. So if you've got the house and land package up front, that can generally just be one loan for the whole lot. If you've got sort of a land and build scenario where you've done the land first and the build, that can also be combined into one loan, generally speaking. Not always, depends on the lender. But in that scenario, you may need a second loan, especially if, for example, you fixed the land loan. Maybe you fixed a land loan at a cheap fixed rate. Well, then the second build loan would need to be a separate loan. Can I switch to a standard loan later? Yes, if for some reason you've had to go with a non-standard build loan, which would be really for the more exotic things, then yes, we can refinance or internally or externally refinance you to get a better deal. Can I include a pool or shed or use a different? Can I include a pool or shed or use a different contractor than the builder to save money on things like fencing? Yes, you can. So it's a good way to save money as well, and also maybe get more variety in what you want. So including a pool or shed, no problems at all. Not with all lenders, but some lenders don't mind that. So what it means is you can come along with your build contract and also your pool contract or your shed contract or whatever it is you want. And we go to the valuer and we say, hey, valuer, we're building on this block of land, this house, and this pool, for example. And some of the banks will allow you to do that, and will fund all of that. So when you do move in, you've now got your dream house. You're not sort of having to compromise on what you're looking to do. And it can be a lot easier to do that when you're building the house, especially if you've got a sort of a narrow block. Once the house is built, if you want to put a pool in behind the house, that can be quite difficult. You'll almost need a crane or have to do a concrete pool or something like that. So certainly certainly possible. And other items that we see a lot of our clients doing these external contractors for is things like landscaping. So rather than paying the builder for that, you find someone that might be cheaper or better, and driveways. Sometimes I've seen people do flooring. They've got a better deal on tile than the builder was doing. So you certainly can include extra sort of quotes to do some of the work and therefore have the builder do less of the work. What happens if the builder doesn't finish on schedule or costs more than expected? So if it doesn't finish on schedule, look, we will obviously guide you through the whole process, but if it goes too long, we might have an issue with the bank. That is, the bank's not giving you money for forever. So if it goes too long, we might have an issue with the bank, and we need to get a new approval. If the costs go up and you can't afford the extra yourself, then we can go back to the bank and ask them for some more money. There is some risk with that. They may not give it to you. Maybe the valuations have fallen. Maybe you can't afford the extra money. So that is one of the risks of building, is if costs do go up and you can't afford the extra, then you'll be in a bit of a pickle there. So we're there to sort of help you through that process as well. How do lenders value the property as of complete, and why does this affect my borrowing capacity? So how they value the property as of complete, we sort of discussed briefly before, but the valuer will go out there and go, what will this property be once they build this house with this pool on this block of land? And that's what the bank will lend against. It affects your borrowing capacity because maybe you think it's worth more than that. Maybe you think it's actually, worth 100 grand more, or maybe they values it at less because they think you're building, some mansion on a place where where there aren't mansions, and so that might affect your ability to borrow that money. So that's how that's done. Can I use equity in my land or existing home to fund the construction? Yes, you definitely can. How do state-based differences impact the loan process? Look, the states just have slight different names for things. So there's different insurances you need and different building license you need based on the state you're in. But broadly, the process is the same, and it won't really impact your loan process too much. It's more that just some of the documentation might have a different name or come in a different format from whether you're in Queensland or New South Wales, etc., etc. And what hidden fees or extra costs should I budget for with a construction loan? Look, like I said, we had just built a house recently, or two of them, and you've got to cover the rates throughout the build. So ours extended for 2 years, took 2 years to build. So we had 2 years of rates, 2 years of water, even though there wasn't actually any water really, 2 years of water, repayments on the loan, and obviously you should be out there sort of keeping the grass down. So if you're not living nearby and you can't go and mow the lawn, you might need to pay someone to go mow the lawn, otherwise you'll annoy your neighbours. So that's really the main things I found. From a construction loan perspective, look, it's really just those progress draw payments, paying $200 to the bank every time they make a payment to the builder. Final page of questions is, what deposit is typically needed for a construction loan? Look, 5 to 20%. If you're doing owner builder or something more exotic, it might go up to 30 or 40%. And our owner builder construction loans treated differently. They are treated differently. You need a bigger deposit. You got less lender requirements. They require a full quantity surveyor sort of check of your costs, so to make sure that what you're building is going to come in on budget. And there's quite a big process around that and some extra costs there. So owner builder loans treated differently because there's more compliance and more sort of deeper eyeballs on what you're doing than a regular build, but otherwise certainly doable. If you're doing a major renovation, do I need a construction loan? Yeah, you do need a construction loan for a major renovation, yes. So if you're doing, unless you can just fund it cash. Obviously, if you've got some cash, you can fund that yourself, but otherwise, that is actually a construction loan. Can I use a construction loan on an existing property for renovation or extension work? Yes, you can. And finally, what makes an owner-builder application higher risk, and how can I improve my chances? Higher risk because you're managing the work yourself, and so there's just less certainty to the bank that you can do that. And what the bank doesn't want is to be left with a property that's half completed and half completed by an owner builder. Also, they're concerned about the quality. If you don't do a good job, then, and you build it and then you disappear or go bankrupt, the bank's got to sell that property to get their money back. And if the property's sort of not built that well, then they might have trouble selling it. So there's a couple of reasons why owner builder applications are seen as higher risk. All right, finally, almost finally, we've got our Progress Protect methodology. It's the ABC system for construction finance. The first part is our clear path approval methodology. We will help you avoid restrictive lenders, maximize the grants, make sure they're paid on time and you know when they're going to be paid so you can manage your cash flow. Include extras from the start, like pool or fences and things like that to save you cash or just to get you the best property, or a complete product that you want, and obviously help you with fast approvals. Once you're actually into the building phase, our builder lender sync system will help you align the builder and lender processes. That can be really tedious. What we don't want is a builder coming at you for, I'm stopping building until you pay the bill or whatever it is. So we'll help you all through that and make sure the bank's sort of paying on time, etc., etc. Handle variations fast. So if you do sort of find we need some more money for something, we'll help you manage that. Tracking lender timeframes and keeping the builder up to date, and obviously also preventing funding gaps. So we'll keep an eye on that. And the C of the ABC system of our Progress Protect methodology is buffer and breathe. So we'll help you plan for the repayments. What will the repayments be at each stage? Can you afford that? Cash flow plans, we'll set aside some buffers if we can early on. So you've got a buffer there throughout that build phase, and we will support you throughout that entire build phase as well. So that's our Progress Protect methodology to help you get this done. If you're interested in booking a consultation and learning more, just jump on the phone. There's a phone number, and jump on the website and book a strategy session. Craig Vaughan here again from Building Loans Australia. Thanks for listening, and any questions, pop them in the comments or just reach out to us. Cheers, bye.